Welcome to Money Talk, making good investing easy. In this edition, what makes women tick when it comes to investing and why men can learn a thing or two. Not all just hot air, how trains and planes are providing a real income alternative for investors. And how living longer could impact your retirement planning. They think before they act, they don't suffer from our egos, and they're in for the long haul. It's no great surprise that when women invest, they're often more successful than their male counterparts. For men, as Jason Zweig puts it, investing is all about machismo. The most important thing is beating the other guy. The second most important thing is bragging about it. And worrying about risk? Well, that's for sissies. Emmylou Montgomery has been to find out whether women really do think differently when it comes to investing.
Google women investors and you'd think men and women were from different planets. Women are more risk averse, while men like the thrill of the chase. Women lack confidence, while men are reluctant to seek help, even when they're unsure about the investment choices they're making. But pop psychology and popular mythology aside, is there any truth in gender stereotyping? Are men and women really wired differently when it comes to investing?
Fund management is still very much a man's world. In the UK, only 7% of funds are either managed or co-managed by women, and in the US the figure is even lower, somewhere around 2%. Sue, interestingly, you didn't start your career as a fund manager, in fact not even in finance. You started in the very female-centric world of fashion. So what's it like for you now when you're actually a woman in what is very much still a man's world?
Every fund manager will have their own individual style, and if you're confident as a fund manager, you will choose, your stocks and your portfolio construction based on your own experiences and your own ideals. I don't think I've ever felt that I've had to act in a different way, even though I've always worked with more men than women.
So if women can be successful investors, why are they so reluctant to invest?
Women are, I think, much more risk aware than men, not necessarily cautious or risk averse. But I think sometimes the way people talk about investing, it doesn't really address those concerns that a lot of women have, or address them in a way that actually resonates with them. And I think there is evidence that women are also much more put off finance in general and investing in particular by the frankly impenetrable language. And whereas I think some men may not like the jargon but kind of go along with it, think it's part of the deal, women tend to be a bit more like, well, if I don't understand the language, if I feel it's not speaking to me, I don't really want to get involved. And that's where I think the problem lies.
I would say fundamentally that women are probably longer term in their view. Building a portfolio, not being distracted by the noise that goes on in the market is probably something that women are better or more biased towards.
So do women tend to trade less frequently than men?
I would say yes, but then if you're a long-term investor with a long-term approach, then naturally you're not looking to turn your portfolios over significantly. I would say that is a trait more to do with long-termism than necessarily gender.
Women tend to do more research before they invest, so are then more confident about the decisions they've made and feel more comfortable sticking with it. They tend to get in and out of the market less or switch to their investments less. And of course, every time you make a change, whether buying or selling, you'll normally incur some charges, which can have an impact, especially in a low return environment. And also, women do tend to see investing as being something they commit to for the longer term and sort of stick with it through thick and thin, rather than thinking of it as being more akin to trading and trying to get a short-term profit.
Realising that the inherent differences between men and women when it comes to investing are not that great is actually incredibly liberating. Both men and women are affected by their emotions, but emotions alone do not dictate whether you're a success or a failure as an investor. Whether you're male or female, the rules of successful investing are the same. As legendary investor Warren Buffett once said, rule number 1, don't lose money. Rule number 2, never forget rule number 1. He might be a man, but who can argue with this simple investment strategy?
So the lessons are that to be a successful investor, whether you're a man or a woman, the strategies are the same. Focus on your goals, invest in what you understand, and take a long-term view. Still to come, we find out how increasing life expectancy means many of us can expect to have more than one retirement. But first, rock-bottom interest rates have left us starved of income. Increasingly, we're having to take more risks to capture a decent yield. You can still find income from traditional sources like bonds, shares and property, but it's not easy. It's no surprise then that a number of offbeat sources of income are attracting growing interest. Claire Dwyer has been to find out more.
Decisions taken by those at the top here at the Bank of England have contributed to the fact that interest rates have never been so low for so long. The income crisis we're still experiencing today began nearly a decade ago with the seizing up of the global financial system.
The collapse of first Bear Stearns and then Lehman Brothers shattered the financial world's confidence. Lending ground to a halt, banks lost faith in their counterparties, and there were devastating and still unfolding consequences in the real economy.
Faced with the kind of slump not seen since the 1930s, the authorities swung into action with emergency monetary and fiscal policy. In 2008, UK interest rates stood at 5%, but were soon slashed to a 300-year low of 0.5%. For many, the evaporation of a decent risk-free income has focused the mind on a fact of life for investors. There's no such thing as a free lunch.
Higher returns imply higher risks, and in a low-rate environment, an acceptable income almost certainly entails a higher chance that you could lose part of your capital. That's the bad news. The good news is that low deposit account interest rates don't have to mean poor returns, but they do mean that you might have to broaden your search.
Alternatives is the catch-all term for those investments which don't fit neatly into traditional asset class categories. It covers things like gold, silver, art, even classic cars and wine. But increasingly professional investors are looking at things you might not have thought of as sources of income: renewables, infrastructure, even aircraft leasing.
Renewables are a great investment for investors seeking income because, generally speaking, they're financed through long-term contracts ranging from 10 to 30 years. So they provide a steady stream of cash that supports the income that investors are looking for. Additionally, this is a great time historically to invest in renewables because there's a very strong regulatory push to introduce renewables into the energy mix. And this is because of the overwhelming evidence that climate change is happening.
From an income perspective, infrastructure, which incorporates roads, transport and shipping, is also a compelling option.
Infrastructure assets are highly cash flow generative, and that cash flow tends to be made available to investors through either dividends or yield. It's quite income generative, and so it will tend to fit within a portfolio. For individual investors, the best way to access them would be through public equity markets, and that could be directly if you have the time to do the research and get to know each of them individually, or it could be through a specialist infrastructure fund or a diversified multi-asset fund with exposure to that space.
Over the past decade, multi-asset fund managers have increasingly been embracing the opportunities presented by aircraft leasing.
In today's environment of low interest rates and low yields on traditional asset classes, investors have to look elsewhere in order to generate an attractive level of income. And aircraft leasing provides the potential for high income as well as some potential for growth, and it's also uncorrelated to other risks in investors' portfolios. These strategies are normally accessible through listed investment companies, so they're a listed company on the stock exchange. Now investors can access them directly, or if they want to diversify their sources of income, they can access it through a multi-asset income strategy, which provides diversified exposure to other sources of income as well.
In a lower for longer, possibly forever world, unusual and potentially lucrative investments are increasingly taking the place of their plain vanilla counterparts in portfolios. With greater potential for high returns comes higher risk, but carefully chosen and blended together, alternatives may well provide a good income solution.
We can all expect to live longer than our parents, and that's a good thing. Retirement is a very different proposition today. But it does pose questions, not least how all those extra years will be paid for. Ed Monk has been out to find the scale of the challenge.
What does retirement mean to you? Not so long ago, it would have been a round of golf or gardening or cruises, but the fact that we're all living longer has dramatically changed what it means to be retired. Those approaching retirement now see it differently.
I cycle to work, I cycle recreationally, do a lot of long cycle rides.
I like windsurfing, I like water sports. So sport is a big part of my life. I fully accept that I won't be able to play at the sort of speed and level I do at the moment, but I seem to be doing okay at the moment, and so I'll carry on as long as I can.
Living longer is a challenge we all face, but how much longer?
It will be quite ridiculous if we foresee a future where we're expecting to retire at the age of 65, when at the age of 65 people can expect to live for another 35, 40 or even more years towards the end of this century. I think workplaces will become very different, and the way our careers develop will become very different. We're even beginning to see the beginnings of this now, where people in certain types of occupation at least retire from that occupation, from that career, and begin a new career quite late in life. And also we're seeing people unretiring themselves.
Both myself and my wife, we have the sort of jobs whereby we can start to wind down and work on a part-time basis in more of a sort of consultancy role. So I think we both aim to do that. How much we wind down over what period, I don't know yet, but I think we're going to be active in the workplace for quite some time yet.
Working longer is part of the solution, but is it enough? Traditional ways of paying for old age are feeling the strain.
I think we're moving increasingly towards, not in the immediate future, but we will in the longer term, move towards certainly state finance pensions, which at best will keep you out of poverty. Anything beyond that, I think increasingly we'll see, will have to be the responsibility of the individual.
Luckily, there are more tools available than ever before.
When we think about retirement, we tend to think about pensions. So we have the state pension. If you've been employed, you'll probably have had a company pension, and you may even have a personal pension. But increasingly, we're seeing people working into retirement, perhaps having a part-time job or even starting their own business. On top of that, they may have other savings, ISAs or other investments. And a lot of people are thinking about using their house as part of the pension, but that needs to be treated with caution because downsizing or getting money out of your house can be a tricky thing to do.
What we've managed to do over a number of years is get some pension plans set up, but we also have some houses, so we get income from those. So we've got a spread of assets that we basically get an income from.
So how much should we be saving?
How much you need depends on when you're going to retire, what sort of lifestyle you want and what other sources of income you've got already. But as a general rule of thumb, we'd say that whatever income you do need, you probably have to have a savings pot of 20 or even 25 times that amount to give you that income through your retirement.
I'm very, very conscious of the size of my pension pot, which is much smaller than it should be.
I know how much I've got, but really I've done no thinking about how much I'm going to need for what we need to do.
Saving enough for a comfortable retirement takes commitment. That's why it's essential to make the most of any help on offer.
If you're in a company pension plan, your employer will often match any additional contributions you make, so it's certainly worth taking advantage of that. And another tip that I often give is that when you get a pay rise, think about putting some of that away into your pension as well. It's often easier to give up money you've not got used to having in your pocket.
None of us can predict the future, but there's no doubt that we're all living longer. The good news is that a more active and healthier retirement awaits us. But coping with that means saving more, it means maximising your options, and it means planning your retirement. But the good news is that it's never too late to start.
I hope this edition of Money Talk has given you some useful investment insights, whether you're male or female, coming up to retirement, or looking for alternative sources of income. You can find out more from me and my team on all Fidelity's digital and social channels. Thank you for watching. Goodbye.